Rebroadcast.
It shouldn't.
All right. I don't know if people can see us or not. Yeah, I think we're live.
Yep.
Okay.
Shows us live.
Okay. Cool. So welcome to our first live stream on Twitter Spaces of the crypto yield curve space, I guess. With me is team member Jason. We're building size credit, and we're just gonna talk a little bit about what's going on with DeFi yields. Jason, how's it going?
Good. Good. Doing good.
All right. So, um, this is our first time doing this. I anticipate this will be like, I don't know, 15, 20 minutes. And what I'm planning on doing is just plotting out what is going on with yields in DeFi over the upcoming term structure in the near future. So I've gotten some of these rates and cut and paste some screenshots of various pieces of data. So I'll start with the Aave variable rate, which is 4.3%. And I'm going to drag that over to the chart here. So it's a variable rate, so it's very short term. You can enter, exit anytime you want. And that's pretty low compared to what had been going on, let's say 3 months ago. Next is the Athena SUSDE yield, the current yield, and that is right around 4%. Let me see if I can, well, we could just put them overlapping, that's fine. So roughly 4.0%. And then if we look at the recent auctions from Term Finance, so let's look at the first one here. This is the collateral asset being SUSDE and the borrow asset being USDC. And the market clearing rate is 4.5% with the maturity being May 1st. And I think this auction happened like just last week, end of last week. So I think these rates are still relevant. So I'm going to put that data point on my chart. That's roughly a month out. So let's see here. Right about there. Term also recently had an auction where the collateral asset was WBTC and the borrow asset was USDC. And again, the maturity is at the end of April, and I think again this just happened last week, so I think these rates are still valid. So the market clearing rate was 4.25%. So we're going to drag that point 5.2, so right about somewhere right around there. Next, let's talk about Pendle. So Pendle basically generates zero coupon bonds, which they call PT tokens, principal tokens, where the purchaser of the PT token locks in a yield that matures at some point in the future. So the PT token for AUSDC, so Aave deposits, maturing on June 25th. So is 4.1. So let's see, June 25th.
And to note that This is relatively low TVL, this pool.
That's right. Only a couple 100,000, if I remember right. Let me just get this point a little bit better. Hold on. So right around there. Jason, let me know if I'm plotting these incorrectly. And then where a lot of the action is recently in DeFi is in these PT tokens for SUSDE, the underlying Athena yield. So maturing in 51 days. So May 25th, the yield is about 7.8%, and on July 30th, also 7.8%. So let me just drag those over. Somewhere around there, and then the May PT token is also so May 28th, so somewhere around here, right around that same level. And then just to compare DeFi to TradFi, we have the U.S. Treasuries curve, which starts at about 4.3%. So let's see, 4.3, something like that. And let's talk about what this all means. So, I think the very first observation is that the majority of the DeFi yields are below the U.S. Treasuries yield. And so there's not much incentive for people who live in both worlds, TradFi and DeFi, to make deposits into DeFi protocols.
And this is in pretty stark contrast with the last, 6 months even. Perhaps even longer, where yields have been quite high, higher than the US Treasuries.
Yes, and especially I would say like early December, mid-December, late November time period, and certainly nothing compared to, let's say, DeFi summer. And with any of these protocols, you're taking some smart contract risk and other types of risks, and the U.S. Treasuries are considered risk free. So it really make a lot of sense for people to put money into DeFi protocols to earn a yield, although they're doing it. So, but the calculation is biased against DeFi at the moment. Next conclusion I would say is that against vanilla, quote unquote, vanilla collateral like WBTC or ETH, the yields are pretty depressed, largely below treasuries, and it's only when you get to Athena tokens and or SUSDE that the yields rise, and there's maybe two ways to interpret that, right? One way is to say that the market is anticipating that the native yield of Athena is going to rise over the next few months. And so people are locking in these high rates, somewhat high rates today. And, the source of the yield for Athena is this both the native ETH staking yield and the short perpetuals yield, and because they create a delta neutral position. And so, again, one interpretation is that combination is going to earn more, a better yield than something like Aave, where the yield is generated from borrower demand. I don't I'm not sure that's true. And Jason, maybe you can elaborate also on why you don't think that's likely the case.
Yeah, I think that these PT yields are still inflated from the points campaigns. Resolve, we're seeing Ethereal or EUSDE enter that rotation as well. And basically the dynamics for that are that you get points if you buy YT tokens for these various protocols. And because of the relationship between YT tokens and PT tokens, if the price of YT tokens goes up, then the PT price goes down, or in other words, the implied yield goes higher. And so I think what we're still seeing with the high PT yield is basically equity being given out in these various protocols, driving that yield up. And I would lean towards that as the reason for the higher yield rather than people betting on um, the real yield or underlying yields going up in the future. And at some point, I think this will be arbitraged away, but I don't feel like we're quite there yet. And I think there's also, one other observation here is that there's certainly an opportunity cost to be lending against the vanilla collateral, like you pointed out, which have quite lower rates for longer tenors, right? Like, why would I lend against WBTC for 4 months for a 4-month tenor when I could just buy a PT token and be earning, 8+% depending on the PT token. And I think at the same time, the time DeFi time preference remains quite high. And meaning that, DeFi DeFi borrowers probably only want to borrow for a couple weeks in general to go farm something else with that money that they borrowed, or to buy a token that they hope appreciates in value before paying back their loan. And so we have a bit of a mismatch where there's potentially not a lot of interest in providing liquidity for longer tenors. And at the same time, borrowers have a high time preference. And the big question there is like, how do we extend out the term structure and start thinking in terms of years instead of days? And it's a bit of a chicken and egg scenario, in my opinion, at the moment.
Right. And I, looking at this chart, I agree with you. If I wanted to earn a dollar basis yield, I would just buy a PT token or lend USDC against it, to earn a slightly lower yield than what the PT token is earning. Why would I ever lend USDC against WBTC? But people are doing it. There's, I don't know what the volume on this term auction was, but people, lend USDC against WBTC. And on mainnet on Aave, there's like, I think 20 billion in their main pool. Maybe not that much, but there's billions and billions in their main vanilla asset pool. So people are doing it. And why do you think that is? Why are they giving up these juicy PT yields and just lending their USDC against vanilla collateral and earning less?
Yeah, I think certainly smart contract risk, like you brought up, is a big factor.
And by that,
Flexibility.
you mean greater smart contract risk on Pendle as compared to Aave?
Yeah, yeah, exactly. So there's newer protocols are thought of as more risky. I would argue, Pendle's probably thought of as more risky than Aave. I don't know if that's fair or not. But Aave's been around longer and has had more TVL for longer, so more TVL days, if you want to call it that. And then I think that there are other risks, specific to SUSDE that investors either aren't comfortable with or perhaps just don't understand. And when you buy a PT token, that's not USDC denominated. You could lend against a PT token, but what you're buying is denominated in SUSDE, which could lose value or liquidity, at maturity, and or they could get hacked, or a whole range of things could happen there that could make investors uncomfortable. And one way of maybe looking at a PT token is risk-free yields in that underlying itself, right? And you can kind of view PT tokens as the risk-free price. I mean, smart contract risk that we just talked about in Pendle, but you could think about it as risk-free yields in that underlying currency. And I think that's a helpful way to evaluate PTs when comparing them against each other.
Right. So, yeah, you have two newer protocols in Pendle and Athena. Then something like Aave, which has been around probably since 2018, 19, since the ICO era. So that's probably has something to do with the reason why there's so many people willing to accept these lower yields. Um, Another observation here is that in TradFi, the Treasuries curve is relatively flat to down over the near term, over the next 8 months. And that typically signals either, very little growth or no growth or even a pending recession. Now it's been flat for a couple of years, so it's not a immediate signal, let's say. But similarly, DeFi, the term structure is also flat. Whether you look at these more, vanilla collateral types, or whether you look at Athena, SUSDE, that you get 7.8% whether you lock in till May 28th or July 30th. And I think the DeFi term structure is mirroring the TradFi term structure of a relatively flat to down yield curve. Any thoughts on that, Jason?
Nope.
And Jason, you had a larger point about I don't know if we discussed this already, but like what will it take to get real term structure in DeFi? You want to talk about that?
Yeah, so I guess we kind of covered my concern about it with the um, points creating this opportunity cost to lend against other collaterals for longer tenors. And that might be one ingredient, but perhaps a smaller ingredient. I think so what we're working on at Size is trying to figure out how to provide more efficient, capital efficient liquidity across the yield curve. That's something that is also certainly missing in DeFi. If you go to most fixed rate lending protocols, there's buckets for every maturity, and by having a separate AMM for every maturity, you get this liquidity fragmentation that makes it difficult to borrow in size without slippage. So that's one problem that we're working on as well. And yeah, what else do you see, Gaurav, that might be missing?
Yeah, so I think we're missing more sophisticated users and investors with a longer time horizon. Um, Although I think they're coming. I think they're maybe here already in a small percentage, but I think they will definitely come in the next bull market. Um, and I think just to go back to your larger point is from what I understand you're saying is that points campaigns are hindering the development of term structure, or at least like masking the real yield, and so people don't actually lock in real yields. They're really locking in points and airdrops, and so it's hard to tell what the underlying real crypto yield curve looks like.
Yeah, exactly. So that's I guess my concern on the supply side, and then I think the demand side is equally undeveloped. So it's kind of a question of how do we build those up simultaneously to the
Yeah,
point where um, sophisticated capital or relatively risk averse DeFi users become interested in these earning these term premiums.
right. Um, okay, that's all I wanted to discuss. Jason, do you have anything else?
No, I think that's a wrap. That's great.
All right, and we hope to do these live spaces with the reviews of the yield curve and also maybe other larger topics once a week. We're going to try for Mondays, and I hope all the listeners can join in. Follow Size Credit on X, and yeah, we'll see you next week.